with the push of interest into Spain, and Spain perhaps doesn't have the servicing platforms that exist in other countries like the UK, Germany, Italy, how the investors are going to resolve that challenge, and furthermore, what thought has been given to the consequences of having very similar resolution strategies. So, for example, when people went back into Germany and made assumptions on how they're going to work out different assets, a number of those assets were going to go through the foreclosure process, and they didn't realise that everyone was going to turn up at the same courts at the same time and basically clog them up. And we've heard from the panel people talking about IRRs, and everyone thinks, well, what's the asset value and how do I get to it? And of course, one of the things that kills your IRRs very quickly is if your timing is wrong. And I've sat in the past managing assets and getting told by the servicing platform, you need to roll that another 6 months or another year because certain things have slowed up the process. And that immediately hits your bottom line in terms of your return. And if you have that on a lot of assets, that can very quickly turn into a very painful exercise. And then you start thinking about, do I have to restructure the workflow of the servicing platform? So I think what we have, in a way, is that we're moving towards today more of a seller's market. The talk of here has been the opportunity from a buy side, perhaps, has been a focus. But I think with all this capital that's being raised, with the pressure to put it into the market because people do not want to give it back, they're in the fund management game, not the fund return game as such. Institutions will be able to take more than the simplistic strategy when it comes to non-core assets, which I think is an important point that Matthew hit upon. It's not all about distressed, it's about non-core, which will have various components in it, including very good quality performing assets. It is how they take a view on, do they take the large-scale transaction which creates good press, which maybe helps share price, maybe gets the regulators off the back of those institutions selling, or do they try and extract assets from it where they will get better value by doing individual deals? I think we talk about fund managers who have come in, these opportunistic funds who are buying things, and I think it was David who hit upon the point is, well, what's their time frame? They're relatively short term, so they're really an intermediary. They're moving the process through, but ultimately they're not the long-term owner of the assets. And in fact, the long-term owner of the assets will be, in many cases, pension funds and so forth who want to buy and match against their assets and liabilities. And a number of those do buy off those platforms. So the question is, in the same way other intermediaries have been disintermediated in other markets, will you slowly see some of these intermediary owners of assets being disintermediated?
In terms of whether they sell portfolios of individual assets, I think because of the market at the moment, the weight of equity, there is actually a premium to achieve through a sort of portfolio exit, and obviously the regulatory drivers are pushing the banks that way anyway. And we're actually seeing that as well on direct asset disposals, where clients who originally had a business plan to sell assets separately are now bundling them up into a portfolio. In terms of disintermediation, I'm not sure that will happen, because effectively the intermediary fund doesn't just sit there, they convert the product and into something that works more for the institutional exit market. They have to do something, there's managing to core plus. They've taken a view on the tenant agreeing to an extension. It's when the tenant has agreed to an extension that it becomes more an institutional product. So I think there'll always be a role for capital that fulfills that function and which generates potentially to investors that level of return. In fact, we're seeing more and more capital piling into the value-added stroke opportunistic area, particularly as the returns are coming down. On the timing issue, I think our experience is that the purchase of these loans are sophisticated. It is an IRR-driven business, as you say, as opposed to an equity multiple business. and they recognise that they have to do consensual deals with borrowers, and almost invariably they're able to do that because there's no legacy of history between the two. They've got a lower acquisition cost, and they would incentivise the borrower. Either the borrower will just walk away, or they incentivise him in the capital stack. It may be an incentive if they achieve an exit price above a target amount. It may be indirectly incentivised against the criteria on their loan-on-loan financing, where they're going to be heavily incentivised to accelerate disposals quickly to repay the loan. And some of these, we've been involved in some of these NAMA disposals where you're dealing with a single borrower, and then effectively the guys are buying the loan. They can't technically speak to the borrower during that period because of all the NDAs, but as soon as the loans are bought, a dialogue starts immediately about effectively, it's not just an asset management arrangement, it's a joint venture arrangement with the borrower taking positions in the capital stack at different places, and that's partly because they have information that's necessary to take the business plan forward, particularly again if there's some operational aspect to the underlying assets, and partly because there are all these constraints on enforcing in Spain, Italy, Germany, and therefore it's much better to go down the consensual route.